Right now, today, in February 2026, there is a very good chance that you do not actually own your stocks. You do not own your bonds. You do not even own your retirement account, not the way you think you do. And the man who figured this out, a retired Wall Street insider named David Rogers Webb, has been warning the world about it for years. The banks tried to stop him. The lobbying groups called him a conspiracy theorist. But the documents he found are real. The laws he is talking about are real. And what is coming next could be the biggest transfer of wealth in human history. Most people believe that when they buy a stock or a bond, they own it. They can see it in their brokerage account. They get statements every month. They feel safe. But here's the truth that Wall Street does not want you to know. When you buy a share of stock through your broker, that stock does not go into your name. It goes into a giant pool. A pooled account held by an organization most people have never heard of. The Depository Trust Company, or the DTC. The DTC sits at the very top of the financial system. It holds trillions of dollars of assets for millions of investors. But here is the critical point. The DTC does not hold those assets for you. It holds them as collateral. Collateral for the biggest banks in the world, banks like JP Morgan. David Rogers Webb spent decades working inside the global financial system. He worked at a senior level in capital markets. He saw how the system was built from the inside, and what he found, buried deep inside a U.S. law called UCC Article 8, shook him to his core. The UCC stands for Uniform Commercial Code. It is the legal foundation of how securities, your stocks and bonds, are handled in the United States. For hundreds of years, securities were personal property. If your bank failed, your stocks were still yours. You could call them back. You were protected. But in the 1990s, quietly, without most people noticing, the law was changed. Article 8 was rewritten, and with that rewrite, your legal ownership of your own securities was quietly removed. You still see your account balance, you still get your statements, but what you actually hold is now called a security entitlement, not ownership, a claim. And in a crisis, that claim goes to the back of the line. Webb explained this in a 2025 interview. He said for hundreds of years, securities were your property. If the banker or the custodian failed, that was entirely their problem. You could just say, send my assets here. That bulletproof protection is now gone. Today, if your broker fails, you have no legal right to take your property back. Attorney Don Grande, who has been fighting this in state legislatures across America, confirmed the same thing. He said Article 8 contains two hidden exceptions. The first exception gives banks that lend money to your broker priority over you in the event of insolvency. The second exception gives lenders to clearing corporations priority over you as well. In plain English, the bank gets paid first. You get whatever is left over. And in a real systemic collapse, there may be nothing left over. Now, you might be thinking, okay, this is concerning, but when would this ever actually happen? This sounds like a theory, something far away. But this has already happened. In 2008, when Lehman Brothers collapsed, clients who thought their assets were protected found themselves trapped inside a bankruptcy process for years. In 2011, MF Global, a major brokerage, went under. Over $1.6 billion of customer funds simply disappeared. Clients were told their money was safe. It was not. In 2013, in Cyprus, the government and the banks came together and took money directly from depositor accounts. They called it a bail-in. Regular people woke up one morning and a percentage of their savings was simply gone. These were not theories. These were real events that happened to real people. And Webb says the next one, the big one, will be far worse. Because today, the global system is carrying far more debt, far more leverage, and far more risk than it was in 2008. Stay with me because in the next part, I'm going to show you exactly how JP Morgan fits into all of this. JP Morgan Chase is the largest bank in the United States. It manages over $3.9 trillion in assets. It has more reach, more political connections, and more legal firepower than almost any institution on earth. And according to David Rogers Webb, it is not sitting at the top of the financial system by accident. It is sitting there by design. And when the next major crisis hits, that position at the top of the chain means something very specific. It means JP Morgan and institutions like it get first access to your collateral, not second, not third, first. Here's how this works in practice. When you open a brokerage account and buy stocks, your broker holds those stocks through a custodian. That custodian connects upward to a clearing corporation. That clearing corporation connects to the DTC, and JP Morgan, along with a small group of other megabanks, sits as a secured creditor at the very top of that chain. In calm times, this structure is completely invisible. You see your account, everything looks fine. But the moment a major institution inside that chain fails, the priority rules of Article 8 are triggered, and the secured creditors at the top, the JP Morgans of the world, get paid first, out of the pooled assets, out of what you thought was yours. This is not speculation. The Federal Reserve itself has acknowledged it. In documents that Webb uncovered and published, the New York Federal Reserve confirmed that under UCC Article 8, if a clearing corporation becomes insolvent, the claims of its creditors have priority over the claims of entitlement holders. The bank's claim comes before your claim, always, and this priority cannot be overridden by a judge, by a regulator, or by any emergency law. Webb found language in actual court documents describing the beneficiaries of this system as the protected class. Everyone else is unprotected. Everyone else waits in line. The 2005 safe harbor laws made this even more explicit. Under those rules, secured creditors were given the legal right to seize assets immediately and without judicial review, without a court order, without any waiting period. The moment a triggering event occurs, they can move. Webb said the plumbing is already in place. The legal certainty has already been established. The only thing needed now is the crisis itself. What would that crisis look like? Global debt today is sitting at over $315 trillion. The derivatives market, a system of financial bets layered on top of other bets, is estimated at over $600 trillion. These numbers are almost impossible to comprehend. Webb compares the situation to a building quietly filling up with gas for years. Everything looks normal on the outside, but one spark, one major bank failure, one sovereign debt crisis, one large hedge fund blowing up, and the chain reaction begins. And when it does, the legal structure is already set up to protect the banks at the top and leave everyone else exposed. There is also a global angle to this story that most people completely miss. Webb points to Euroclear, a massive clearinghouse based in Belgium, where a large portion of Russia's central bank reserves were held. When the war in Ukraine broke out and sanctions were imposed, those reserves were frozen. Hundreds of billions of dollars belonging to a sovereign nation's central bank were simply immobilized inside the system. Webb's point is this: if it can happen to a country's central bank, it can happen to you. The infrastructure for asset immobilization already exists. It has already been used on a national level. And if sovereign money can be frozen overnight, your retirement account is not safe either. JP Morgan has never confirmed any of Webb's claims and publicly presents itself as a trusted partner to its clients. But the legal architecture Webb is describing was not built by JP Morgan alone. It was built over decades with the involvement of central banks, regulators, and major financial institutions working together. And right now, in early 2026, with markets still volatile, global debt at record levels, and geopolitical tensions running extremely high, the conditions Webb has been warning about are not getting better. They are getting worse. In the next part, I am going to show you the specific fight that is happening right now to try and stop this, and why the banks are doing everything in their power to make sure that fight fails. There are people fighting back, real people in real state legislatures across America, trying to change the law before it is too late. David Rogers Webb did not just write a book and disappear. He has been traveling across the United States, meeting with lawmakers, presenting evidence, and pushing for one very specific legal change, an amendment to UCC Article 8 that would restore true ownership rights to investors. And at every step, the banking lobby has been waiting for him. Attorney Don Grande, who leads a legal group called True North Public Policy, has been coordinating the legislative effort. By early 2025, they had introduced bills to reform Article 8 in North Dakota, South Dakota, Tennessee, Oklahoma, Iowa, Utah, Texas, New Hampshire, and Arkansas. These were not radical proposals. They were narrow, targeted amendments designed to remove the two hidden exceptions that give banks priority over investors in insolvency situations. Simple, logical, supported by legal experts who reviewed the evidence, and still, in almost every single state, the bills were killed. Not because legislators read them and disagreed, not because there was a public debate. They were killed quietly in committee after lobbyists from the major financial institutions made phone calls and showed up at hearings with prepared talking points. Webb described the experience in stark terms. He said the banking lobby is a bully. They threaten people. Legislators on financial committees do not take the time to actually read the regulations they are voting on. Instead, they receive scripts from banking representatives, and they read those scripts back out loud at hearings. The debate is structured so that real questions cannot be asked. Any bill that threatens the bank's priority position over client assets is quietly buried before it can reach a full vote. The banking lobby's main argument is that investors already have legal protections, that Article 8 is fine as it is. But when pressed on the specific insolvency exceptions, the language becomes vague and the answers become circular. They say the existing framework is necessary for modern securities trading to function. They say changing the law would destabilize markets. Webb calls this deliberate misdirection. The system functioned perfectly well for decades before Article 8 was rewritten in the 1990s. The hidden exceptions exist purely to protect the secured creditors at the top. Nothing more. The situation in Europe is even more concerning. In America, at least there is a legal pathway to reform. State legislatures can amend the UCC. In Europe, there is no equivalent reform route at all. The legal structures governing securities custody in Europe are embedded in a patchwork of international treaties and directives that no single government can unilaterally change. Webb has said publicly that he considers the European situation effectively impossible to fix through legislation alone. The institutions are too entrenched. And this brings us to what Webb has increasingly been saying heading into 2026. He is no longer primarily focused on legislative change. His message has shifted. He now believes that waiting for politicians to fix this is not a realistic strategy. The banking lobby is too powerful. The system is too captured. His message now is simpler and more direct. Get your assets out of the system while you still can. Move toward things that cannot be held in a pooled account, things that cannot be seized without physically taking them from your hands. Physical gold, physical silver, assets that exist outside the custodial chain entirely, not in a pool managed by the depository trust company, not pledged as collateral to the protected class. In your hands, under your control. In the final part, I am going to show you the exact 3 moves that informed investors are making right now, and what you can actually do this week to start protecting yourself. Let us talk about what the smart money is actually doing right now, because while the debate about the great taking continues in state legislatures and online forums, there's a separate conversation happening among people who work inside the financial system. People who understand the legal architecture, people who have read the documents, and those people are quietly making moves that most retail investors have no idea about. The first move is physical precious metals. Not paper gold, not an ETF that tracks the gold price, not a gold mining stock. Physical, allocated, segregated gold and silver that sits outside the custodial chain entirely. Webb has been saying this for years, and the data in early 2026 is backing him up hard. Germany recently called for the repatriation of $122 billion worth of gold stored in overseas vaults. Countries across Asia and the Middle East have been accumulating physical gold at a pace not seen in decades. Central banks globally bought more gold in 2023 and 2024 than at any point since the 1960s. These are institutions that have full visibility into how the legal structure of the financial system works, and they are choosing physical metal over paper claims. That choice is not random, it is deliberate. The second move is understanding what you actually own inside your brokerage account right now and taking steps to reduce your exposure to pooled custody. Some investors have moved toward direct registration of securities, a system called DRS, where shares are held directly in your name on the issuer's books, rather than through a broker. This removes some layers of the custodial chain. Others have reduced their overall exposure to financial assets and increased their allocation to hard assets, real estate held free and clear, farmland, commodity-producing assets, things that exist in the physical world and cannot be dematerialized by a clearing corporation in a crisis. The third move, and this is the one almost nobody is talking about, is paying very close attention to the tokenization wave currently being pushed by major financial institutions, including JP Morgan. Right now in 2026, there is a global push by central banks and major institutions to tokenize real-world assets. Your home, your car, your business equity. The pitch sounds modern and efficient. Everything on the blockchain, everything liquid. But Webb and others have raised a critical warning. Tokenization may simply be the next layer of the same system. If your physical real estate is tokenized and held inside the same custodial infrastructure, the same clearing chains, the same pooled accounts, the same legal priority structure, then you have brought your hard assets inside the very system you were trying to escape. The same rules that apply to your stocks may eventually apply to your tokenized house. Think about that carefully. So what should you actually do? The answer depends on your situation, your age, your assets, and your risk tolerance. But here is the core framework. First, educate yourself on what you actually hold. Call your broker, ask where your securities are custodied, ask whether you are a beneficial owner or a direct owner, ask what happens to your assets in an insolvency event. The answers may surprise you. Second, consider moving a meaningful portion of your savings into assets that exist outside the financial system. Physical gold and physical silver are the most historically proven options. They have been stores of value for over 5,000 years. They cannot be tokenized without your consent. They cannot be pledged as collateral without physically moving them. And right now, with central banks buying gold at record pace and COMEX inventories under serious pressure, the timing is very significant. Third, if you are in the United States, contact your state representative. Tell them you want reform of UCC Article 8. Tell them you want the 2 insolvency exceptions removed. This fight is not over. Webb himself has said that the one thing he did not expect was how few ordinary citizens showed up at legislative hearings. Just a few more informed people in those rooms could change the outcome entirely. Here's the bottom line. The Great Taking is not a future event waiting to happen. The legal architecture is already in place. The priority structure already exists today. What is missing is only the crisis large enough to trigger it. And in a world of $315 trillion of debt, record geopolitical tensions, and a financial system more fragile and interconnected than at any point in history, that trigger is not a question of if. According to David Rogers Webb, and increasingly according to what the market data is showing, it is only a question of when. If this video changed how you think about where your money is sitting right now, drop a comment below and tell me one thing you are going to do differently this week. Share this with someone who needs to hear it, because the people who know about this have a responsibility to tell the people who do not.